The S&P 500 index has had a relatively strong year in 2024. The index is up over 24% year to date in 2024. Now, while the books are not yet closed on 2024, I'm recording this video on Monday, December 30th. Even if the index were to decline by 1 or 2%, it would still indicate a strong year. In this video, I'm going to make my forecast for where I think the index will end up next year. What will be the index level? What will be the percentage growth next year? And to make that prediction, I'm going to look at the S&P 500 index within the context of earnings growth. What are the earnings growth expectations? Because that's what I believe will drive the index higher. That's what drove the index higher this year. I think that's what's going to drive the index higher in 2025. So let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the Wall Street analysts that are following the S&P 500, they expect it to report double-digit earnings growth in calendar year 2025. The estimated year-over-year earnings growth rate for 2025 is 14.8%. That's way above the trailing 10-year average of 8% between 2014 and 2023. This is significant because the earnings growth rate is nearly double what it's been in the previous decade. That's what's driven a lot of enthusiasm in the stock market this year, is the earnings growth of especially for some of the largest companies, including NVIDIA, Alphabet, Microsoft, and others, Meta platforms as well. And so when a company's earnings are growing, and in this case, this is an entire index that consists of many companies, 500 companies, investors are willing to pay a higher price because you're getting more profits. Interestingly, the analysts expect the Magnificent Seven companies to report earnings growth of 21% in 2025, and they expect the other 493 companies in the index to report growth of 13% for 2025. That's still really strong. It's not like the entirety of the growth is going to come from the Magnificent Seven companies, but those companies are expected to grow earnings faster than the rest of the companies in the index, which are expected to grow earnings by 13%, which is still higher than the trailing 10-year average of 8% between 2024 and 2023. Typically, when you have higher interest rates, it's better for larger companies. They have lower costs of capital, and it also reduces competition from smaller companies aiming to disrupt industries. So when the cost of capital is higher, smaller companies have a more difficult time raising funds, and these are companies that are usually losing money on the bottom line. So they can't raise funds and continue to lose money on the bottom line while chasing after growth, which then brings down profitability for industry participants. With the higher cost of capital, these smaller companies have focused a lot more on firming up their balance sheets, firming up their income statements, firming up their profitability, rather than chasing after growth at all costs. That's good news for market participants because that lifts margins for everyone. If you have the smaller companies fighting for growth, trying to take market share, they're usually offering their products at lower prices that are so low that they're still losing money on the bottom line. Then some of the customers' purchases move towards those companies with lower profits, and so that brings down profitability for the index overall. You're not going to see very much of that in 2025. The bigger companies are going to have that advantage, and the bigger companies have been capitalizing on that in the last year and a half, since interest rates accelerated higher. In terms of revenue growth, the estimated year-over-year revenue growth for calendar year 2025 is 5.8%, when the trailing 10-year average is 5.1%. So revenue growth is expected to be higher than usual, but not as much higher as earnings are expected to be compared to revenue. You might be thinking, how can revenue grow at 6% when earnings grow at 15%? And that's the operating leverage that's demonstrated by some of these companies in the index. When revenues grow for some of these companies, they don't necessarily experience higher cost associated with the higher revenue. A great example of this is a company like Netflix. Netflix already has over 200 million subscribers. If they add another 10 million subscribers, that's not going to necessarily add to their cost that much, right? They're already creating the content. And so if an extra 10 million people are watching the content that they already paid for, that's not going to add to Netflix's costs, other than the processing fees that they have to pay to Visa or MasterCard to process the payments, which are a small percentage of the revenue that flows to the bottom line. And so a 5% increase in revenue could lead to something like a 15% increase in earnings per share. I hope that explains the operating leverage concept and how companies are able to grow profits faster than they grow revenue. Looking at the macroeconomic picture, the Federal Reserve expects growth to continue in 2025. They expect real GDP to come in at 2.1% in 2025. They expect the unemployment rate to remain extremely low at 4.3% in 2025. However, they do expect inflation to edge up a little bit, which could drive interest rates higher, and we have seen that. Higher interest rates could mean a lower growth rate for the S&P 500 index because investors will look at their choices and say, well, I can invest in the S&P 500 index and that'll get me a certain percentage rate of return, or I can invest in government bonds which are almost zero risk, and I can get almost 5% rate of return. So that's why a higher interest rate brings down the growth potential of the S&P 500 index, because the incremental capital that's coming into investment markets has an attractive option in buying government bonds instead of investing in S&P 500 index or other equity investments. So I highlighted that the S&P 500, it's already up over 24% year to date in 2024, and the overall level at 5,923. Now, as for my prediction, where do I think the S&P 500 index will end 2025? I think the S&P 500 index will increase by more than double digits next year. I forecast that the level at the end of next year will be somewhere between 6,600 and 6,900, between 6,600 or 6,900. So an increase of a little more than 10% for 2025 is my prediction for where the S&P 500 index will end next year.
Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.